Hi, I'm Adam,
This is Kevin.
and we are Tech Guys Who Invest. This is the place for business people and investors to learn all about investing. We offer a fresh perspective on what it's like to have a day job while investing, and we share lessons learned on our investing journey. Our vision is to educate and entertain you while adding tons of value to your daily commute. Welcome to our show. Hello, listeners. On this episode of Tech Guys Who Invest, we talked to angel investor Dr. Kevin Taylor. I met Dr. Taylor years ago in Denver, before he was a doctor and long before I understood the freedom that investing offers. We kept in touch over the years, and it was inspiring to see him create startups and do great things. Then when he was fortunate enough to become an angel investor, I recall being impressed. But I wasn't quite sure exactly what an angel investor was. Fast forward to today, and we thought it would be great to share exactly what an angel investor is and why someone does this type of investing. Dr. Taylor was gracious and humble enough to come on Tech Guys Who Invest and educate us. As an entrepreneurship professor at Stetson University, Kevin's work includes educating and mentoring student entrepreneurs, conducting research on founders, and directly consulting with founders and teams on strategy, leadership, and growth. Prior to teaching, Kevin successfully launched and sold several technology businesses to Groupon and GoDaddy and was twice recognized on the Inc. 5000 list of America's fastest growing private businesses. He splits his time between Chicago and the Central Coast of Florida. Let's welcome Dr. Kevin Taylor to the Tech Guys Who Invest. So we're so excited to have angel investor Kevin Taylor on the show. Kevin, thanks so much for coming on the show tonight.
Hey, thanks for having me, guys.
Yeah,
Well,
absolutely.
The first question we want to ask, when we hear the term angel investor, especially in the tech space, we were mentioning this earlier, it's like a, whoa, what is that? Who is that? Right? So we want to know what is, if you were to break it down in its simplest form, what is an angel investor?
Yeah, so angel investor has been a term that's been around for a while. Really what it means is it is an individual who purchases equity from a private company. And so just as people purchase equity or shares of stock in publicly traded companies on the stock exchanges, angel investors purchase that equity through private transactions, and the companies aren't publicly traded. So this is the only way to purchase equity in companies is through these private placements, they're called. And so, angel investors tend to be people who've successfully built and exited a business. Many of them are entrepreneurs, or they were entrepreneurs, or they were CEOs of companies. Sometimes they're doctors and dentists and attorneys and other professionals who, have extra cash to invest, and they have kind of that risk
Right.
portion of their portfolio. And of course, angel investing is extremely risky. So you'll find a lot of those people at angel investor meetings.
Well, that's fantastic. Thank you for breaking that down. We'll definitely talk about the risk factor later in this conversation. But when Adam and I invest, we invest for cash flow, right? We want those streams of income. Is something like that possible as an angel investor?
So for angel investment, it's a very difficult investing class because you're typically locked up in this equity for 5 years, 10 years. I have investments that I made. Well, my very first investment was in 2010. 10 years ago, there's no light at the end of the tunnel yet for that investment. I have had exits in a couple of other investments that I made after that, but the investment horizons are long, and you typically don't get any cash back on your investment until there's been some exit event. So either the company's acquired And so a bigger company comes in and buys the company you invested in, and then all the shareholders are liquidated and they can get cash there. Or the company does an IPO. For instance, I worked at Groupon when it was kind of the big up and coming company, and it had an IPO in 2011. And so a lot of the angel investors and venture capitalists got big paydays from that. But there's really very infrequent opportunities to get cash flow from your angel investments. The only time I've really seen that happen is if the investment is a debt instrument instead of equity. And so I have done that a couple of times where I've, instead of purchasing equity from a company, I will just make a loan and then I'll get paid back, principal and interest over a period of years.
So, Kevin, as an angel investor, how do you approach it? Like, what do you look for before you invest in an opportunity?
Mm-hmm. Yeah, so I typically look at about 50 to 75 companies for each one that I invest in. And I think I've invested in about 13 companies so far. And yeah, so it's a lot of pitch decks that I look at, probably 20 pitch decks a month.
Wow.
And I make roughly 2 investments a year. And so it is not, it's not like being in Las Vegas, right? There's not a lot of like dinging and, and coins coming out of the slot machine. It's kind of a slow plodding, type of work. And so one of the keys to finding opportunities is having good deal flow opportunities. That's what angel investors and venture capitalists, they're largely successful in, tapping into the hidden gems, right, that no one's discovered yet, or that everyone's discovered, but when the big players are investing in certain startups, it's hard for you to get into those really great startups because everybody wants in. And so then you have to have a good network of other angels and other venture capitalists who you've done deals with before, who invite you into those like primo investment opportunities. So the opportunities are on those extremes. It's either everyone wants in and you have some kind of a backdoor or connection to get in, or nobody knows about it and you're one of the first ones to discover it.
Wow, a lot of parallels to multifamily investing. It's very interesting. Yeah.
So with the angel investing, you talk about the risk. Can you elaborate a little bit more about what is risky at being an angel investor?
Yeah, so imagine you guys do real estate, and so imagine that you buy a building, okay, and you buy it, but you can't get out of that building for 10 years, right? And so your capital is locked up for 10 years, and you don't know what's going to happen in that local economy.
Right.
You don't know if the tenants are if you're going to be able to put tenants in, or if the tenants move out, are you going to be able to replace them? There's all these risks that you have with that building, and it's a lot like investing in a startup. So you invest with a 10-year time horizon, and you're investing on that management team and their product idea and a certain market. And those are kind of the three, you make assumptions about those 3 categories: the management team, the product, and the market. And right, you're making these guesses, these kind of informed guesses based on pitch decks, based on interviews with the management team. Sometimes they don't even have a product to show you. Many times it's just PowerPoint slides and pictures of what it would look like. And so there's a lot of taking things on faith when you make angel investments, and a lot of gut feeling. So with venture capitalists, they're much more quantitative, where they have complex spreadsheets and they analyze all the numbers, but they're coming into an investment later than angel investors. So the typical kind of funding road path for startup is first the entrepreneur invests their own money. So they may use credit cards, their bank account, a mortgage, and maybe $10, $20, $30,000 they'll invest themselves. Then they go to their friends and family. We really say friends, families, and fools, the 3 Fs. And so then those are the kind of the first quote unquote like third party investors, and they may invest 50 or 100,000 if you're lucky enough to have friends and family who can invest that amount. And then after that, then the angel investors come in, and they typically invest 250,000 up to about $2 million. Okay. And then after that, then it's the venture capitalists, and then venture capitalists tend to invest 2 million up to however many millions you need. That's kind of the roadmap. But for angel investors, because they're coming in so early, they don't have a lot of data to crunch to make quantitative decisions like you probably do in the real estate world. You probably have numbers and ratios you can look at. But with angels, it's like, do I believe this management team, this entrepreneur, do I believe they have the passion and the competence and the ethics to deliver this investment opportunity? Do I believe that their product has a unique value proposition? And do I believe the market dynamics are strong? Is this a growing area versus a shrinking area? And so you kind of make these gut checks, and that makes it extremely risky. So you add that to the 10-year time horizon, and you can see that this is not an investment area for the casual investor. It's something that you really need to walk carefully into and take it slow.
Man, how do you keep emotion out of that?
It's really tough to do, because you really get swayed by the good entrepreneurs. Right. And so I don't try too hard to be a dispassionate investor. I'm more of an activist investor in the sense that almost all the investing and advising I do, I look for people I believe in, and I look for people who are changing the world in a positive way, in a way that I want that product out in the world, or I want this person to be successful. And so I kind of get behind those efforts.
Nice.
Wow. That's cool.
Yeah, it's cool.
So the risk profile with real estate, for example, we have pure numbers that we can look at and say, all right, this doesn't fit my profile. Now you're talking about how you have to follow your gut and things of that nature. Let's say, as a thought exercise, you were to go back in time and talk to your younger self and advise yourself on how to assess risk better. What would you say?
Mm-hmm. Yeah, so there are things that I look at. So, for instance, I look to see for the management team, particularly the founders, do they have specific experience in the area that they're launching their startup in? So a lot of times I see pitch decks from someone who is in hospitality, successful in hospitality, but they're launching an artificial intelligence startup. And I'm like, well, you may be great in hospitality, and I might even back you in hospitality, but all of a sudden launching an AI startup, I'm not a believer. So do they have specific experience? Can they or have they proven that they can sell their idea? This is extremely important. Have they been able to bring in co-founders or early employees or potential clients or other investors? Because if they can't sell their idea at that level, how are they going to go out and sell their product? And then I look at also kind of what we call product market fit, which is, do they have a clear sense of the customer problem that's being solved? And does their product actually solve that problem? Or is there a mismatch where their product isn't really solving the problem they think it is, right? That's the kind of the better mousetrap syndrome, where they've built a better mousetrap, but nobody really has that problem. So we look at that. That's pretty important. And then, of course, which you guys will of course understand, is the deal itself, the terms of the deal, the type of instrument that they're raising money under, because there's different types of instruments. There's what's called a safe instrument, there's a convertible note instrument, and then there's what's called a priced round. And those three instruments are very different from each other. And so you want to make sure that the deal is good for you as an investor, because if you buy into a deal where the valuation is too high, right, you're much less likely to get a good return if they're successful.
Yeah. So continuing on with the funding theme there, in real estate, we love to use other people's money. And I'm curious, as an angel investor, how you fund deals and how you kind of approach that part of it.
Yeah. So angels, by definition, invest their own money.
Okay.
And so you have to be what's called an accredited investor to be an angel investor. And that means you have an income of $200,000 a year as an individual, or $300,000 a year as a couple, or you have $1 million in assets excluding your primary residence. So those are the criteria to be an accredited investor. So we invest our own money. Venture capitalists, on the other hand, who are the kind of the professionals in this game, they invest the bigger money. They follow the route of investing other people's money, OTM, right? So so venture capitalists, they get investors into their fund called limited partners, and then they are the general partner and they make the investment decisions. And they get a 2 and 20 fee structure, meaning they charge 2% of the value of the fund each year in fees. And then any returns, they take 20% of the returns.
Wow.
Yeah.
Nice.
Sounds like a good setup for them.
It's a good setup for the VCs.
Now, can we ask
awesome.
a little bit more about those instruments and break them down just a little bit further? I don't remember the three that you mentioned, though.
Mm-hmm. Yeah, so the most common and most traditional way of raising private equity financing is called a priced round. And that is just simply, I'll give you 100 shares of stock if you give me, $10,000. And so you're paying, a price per share, and you actually hold stock in that company. And that's very similar to buying stock on the public exchanges.
Got it.
So that's the most common. The second most common is called a convertible note. And this is a debt instrument. So you're basically giving the startup a loan. So it's a debt instrument, but it has the option for you to convert that loan amount into equity. And so what happens is that, say I invest $10,000 in your startup in a convertible note, you owe me $10,000, and there's a term and there's an interest rate. Okay, but you don't actually pay on that note. Usually there's like a 2 to 3 year time horizon where you don't make any payments, and then there's a balloon payment due at the end. But the startup is banking that they'll get additional funding before that note comes due. And then when they do, as an investor, you convert that into equity. Okay. I've never seen a convertible note actually pay money back to investors. Either they get additional funding at a marked up price and everyone converts, or they go out of business and everyone loses their money. That's pretty much the outcomes. Now, the third is a more recent instrument called a safe note, or not a safe note. I think it's just called a safe instrument. And this has really only been around for about 8 years. And so SAFE is much like a convertible note, except there's no actual note and there's no loan. So if I invest $10,000 in your startup under a SAFE, you never have to pay that back. Okay, and so as an investor, the only time I get my money back is if there's a liquidity event or someone comes in later and purchases the company at a greater price. And so safe notes and convertible notes are kind of two alternatives that compete with each other. And some investors like convertible notes. Founders typically like safe notes because safes are very simple. They're like 2-page documents, whereas convertible notes are like 50-page documents.
So, Kevin, I'm going to switch gears just a little bit and step back to somebody who hears all of this and finds it very interesting, and they say to themselves, "I would like to be an angel investor one day, but not quite sure how to get there, what a path may look like." What advice might you have for somebody who's pretty young and has time to kind of, make a plan and stick to it to get to where you are?
Mm-hmm. Mm-hmm. Yeah. So what I would say is focus on other things, honestly. Angel investing is more for you've already financially built a nest egg, and you're pretty comfortable putting aside 25, 50 grand a year into these extremely risky startups that most of them won't pay out, and the ones that do, it'll be 5 to 10 years. Now, when they pay out, you're expecting a 10 times return,
wow,
right? Or more, 40 times return. Right. So my best payout was about a 40 times return.
Wow.
So you only need one of these to hit in your lifetime to really make it worthwhile. But, they say that of 10 investments, 7 will go bankrupt. So you won't get anything back. 2 to 3 will be basically break even, or you'll get a 2 or 3 times your investment, and then 1 will be kind of the breakout that gets like a 10 times or better return. But when you average that all together, you're hoping to get 5, 6, 7 times your money. So to get back to your question, I would say focus on things that will get you into being an accredited investor. Okay, because that's required. And then once you're in there, once you're an accredited investor, then I would make a few suggestions. One is there are a couple good books on angel investing. One is by Jason Calacanis. And the other is by, I think, Brad Feld. And I can send you links to both of those books. So those are great books to kind of get started on understanding deal terms and understanding how to evaluate deals and how to find deals. So then I would next recommend join an angel investment group. So the first 7 years I was an angel, I did it completely on my own. Because I come from the tech industry, I had a lot of access to startups and deals, and that's where I found my deal flow. But then I joined an angel group about 3 years ago, and there's 22 of us in the group that we invest together, and so my deal flow probably tripled after joining that group. Right, and then you can learn from other investors. You can get a lot of deal flow. You can lean on each other's expertise. So we have doctors in the group, we have technologists, we have engineers, et cetera, and we can, leverage that. And then the last thing I would mention is there are some crowdfunding sites that you can participate in if you're not an accredited investor. So I would look at some sites like AngelList, Republic. I think there's one called Crowdfunder. And of course, there's Kickstarter and Indiegogo, which don't sell shares. They don't sell equity, but still, it's a good way to kind of start to evaluate products and ideas and put your money where your mouth is.
Great. We'll put all that stuff in the show notes as well.
Okay.
So as part of this advice to somebody that's starting, what would be maybe a red flag or two that you would say, if you see this, you should not put your money here?
Yeah. So this is an area that, because it's not well regulated, there are a lot of kind of shyster type characters who mostly, frankly, target the entrepreneurs versus the investors. A lot of people sell their kind of consulting services to help entrepreneurs raise money. Now, there are some, certainly, if you're a first-time investor or first couple times you invest, it's definitely better to wait to make an investment until there are some well-established investors on board. Because what they do is they do due diligence. So if you have a venture capitalist or an experienced angel group, they'll do the due diligence. They'll do background checks on the founders. They'll look at financial statements. They'll do all of that, and they know what they're doing. And so a lot of solo angel investors or less experienced ones will kind of lean on other people doing that due diligence work. And so I would say, don't be the first one in. Try to see that other more experienced operators are getting into the deal first.
All right.
So
that makes a lot of sense.
During the time of recording here, it's during the COVID period, and we're kind of, who knows how long this will go on, but it feels like we're in the middle of it. And I'm curious, has that affected how you do business?
It has affected my angel activities in a couple ways. One is we can't meet in person, right? And so a lot of angel investing is kind of gauging people personally and kind of sitting across the table from them and kind of understanding who these people are. And it's much harder to do through the video chats like this.
Yeah.
So that's one real negative impact. A positive for angel investors is that a lot of startups are now looking for funding, and where they weren't 3 or 6 months ago, and they're much more liberal on the terms that they'll raise that money. So startups that were valued at $20 million 6 months ago, now they may be raising at $15 million, right? And so that's an opportunity for us, just like the stock market. It's an opportunity for us, if we like that company, to potentially get in at better terms. So I think a third way that it's kind of changed angel investing is there is kind of and you probably see this with everyone you talk to, there's pre-COVID and there's post-COVID. Right. And there's a lot of pre-COVID companies that nobody wants to invest in anymore. And there's a lot of post-COVID companies that are like set up, like the Zooms of the world, that are set up to take advantage of this socially distant world. And I feel bad really for the entrepreneurs who are in those pre-COVID companies where they're doing things that require physical contact, right? Like event companies, like an Eventbrite, for instance. You guys have probably registered for events through Eventbrite. If Eventbrite was trying to raise money right now, forget it. They would be out of business.
Yeah, that's an interesting
meetups. Maybe would have been like that.
Right.
That's interesting. Yeah. Huh.
So with that, with the market cycles, is it a direct relationship or more of an inverse relationship when it comes to the success of an angel investor? I'm not sure if I'm articulating that effectively.
Are you talking about the public stock market?
Yes, I guess so. Yeah. If the market's going down, is that more successful for angel investors, or if on the opposite end, is if it's going up, is it bad for angel investors?
Yeah, it's I think when we're in boom times like we have been for the past eight years or so, there's a lot more money flooding into startups, which means there's a lot more opportunities to invest. There's a lot more competition to get into the best deals. And
Right.
so you have to be really careful because everyone's launching a startup and there's a lot of money sloshing around, but it's only it's only the one or two out of 10 that really are going to explode. And so you have to be very cognizant of the fact that everything is flush with cash and be very disciplined, which is tough to do when you see the $1 billion plus IPOs that are going off, and there's the fear of missing out when times are really good. So yeah, I would say that there's definitely psychological connections between the state of the stock market.
Yeah, interesting. So Kevin, you talked a bit about the reason for investing as an angel investor. There are things that you're interested in, and I'm curious. I'd really like to ask you about like what's your big why? Why are you doing this? Why do you invest in the ones you happen to? Like, what's the big why for you?
Yeah, so it's for me, I'm not doing this because I think it's the best use of my investment dollars. I'm doing it because there are certain products and there are certain entrepreneurs that I want to back. And that's really why I do it. Like I said, like waiting 10 years to get a payoff.
You're a patient man.
Right? You got to be doing it for reasons other than just getting that payoff every 10 years. So I really like to, because I've been an entrepreneur, I've built the technology businesses. I really want to help other people do that and kind of be along for the ride, kind of vicariously through them. You get some, it's fun, right? It's fun
right.
to talk strategy and sales and tech with cool, creative, smart entrepreneurs who are like trying to change the world and change themselves and their future, and to be part of that, and then have the upside of, if it works out, everyone gets a really great payday. That's what excites me about it.
I love it.
Fantastic.
Yeah, that's great. Great perspective.
So one thing you mentioned that I want to highlight is when we asked you about if somebody wants to be an angel investor, that they should focus on finding a way to get to an accredited investor. That status is being accredited investor. I look at that as somebody that, generally speaking, has a greater financial acumen. That being said, what would you say are some resources that help increase financial literacy, or some of your favorite ones?
Mm-hmm. Yeah. So, I spend a lot of time, or I have in the past, reading forums about kind of financial freedom and how to manage portfolios and probably all the stuff that you guys read. I've done that since I was 19 years old, and reading how to invest in real estate, even though I didn't have $1 to my name.
Nice.
Right. But if you do that, if you keep absorbing that knowledge, and you keep your eyes peeled for the opportunities, right? Because I'm an entrepreneurship professor, and so one of the key disciplines in entrepreneurship is how to train people to identify opportunities, and this matters in every single field that you work in, right? Particularly, obviously, investing. But so as you're going, as your listeners are kind of going through their life and making decisions, it's keeping your eye peeled. One, you've educated yourself, right, through reading and learning from the experiences of other people. But two, you're keeping your eyes open. Like when I launched my first tech company, it was really my second tech company, but this is the one that was really successful. I went to my best friend. I said, listen, this is my idea for my company. like, let's quit our jobs and launch this together. And I'm like trying to sell it and everything. And he thought about it and he thought about it. And he's like, Kevin, he's like, I'm at a different point in my life. He's like, I have responsibilities and stuff that won't let me, take this jump with you. And he's like, good luck. I hope things work out. And I'm like, well, okay, it sucks because, this is a great opportunity. Well, I made the jump by myself. Things worked out really well. And, I just look, I'm like, man, I wish you had been on this journey with me because, I saw the opportunity and I was willing to step through that door, even though like I had very little money in the bank when I did that. I had a mortgage. I had 2 kids. My wife didn't work full time, and I made that leap. And some people make it, and some people don't, right? And so, for your listeners, you have to walk through that door at some point in order to get to a point where you have financial freedom. Whether it's investing in a building, or whether it's launching a startup, or moving to taking a more challenging, riskier job that pays better, but you're not sure if it's going to work out.
Right.
These are all opportunities that people take to eventually get to the point of having financial freedom.
That's great. Breaking through fear. Kevin and I talk about that mindset of not letting it hold you back, breaking through that self-limiting belief and the fear, and taking action. So that's really great.
Yeah, I think people need to. That's exactly what it is. It's fear, right? And it's the negative self-talk. And I think people have to realize that what are the risks? What are the real risks of that? What's the downside? Especially when you have coming off of an 8-year bull market. If you have any kind of job skills, it's like, well, okay, so it doesn't work out. You lose, income for 6 months, but then you go get a job again, right? And so unless you're investing your life savings, obviously if you're planning on doing that, like opening a restaurant, for instance, that's extremely risky, and you're typically investing like you're taking out a second mortgage or something. Yeah. Okay. Yes. Be really careful.
Absolutely.
Right? Yeah. But most, many opportunities don't have those kind of existential risks.
Wow. This was, that was
really
great advice. You do have to take action at some point if you want to change your status quo in life. And thank you for that. That was just awesome.
Yeah, agreed. That was really, really good. And, it's really interesting to Kevin and I because when we talk to successful people, there is this common thread, like a common mindset. And it's what you were just talking about. It's having the courage to push through your fear, taking action, and really, just moving forward in spite of fear. So that's fantastic. So, Kevin, we wouldn't be the tech guys who invest if we didn't ask you a tech question. And lucky for us, you're a tech guy who invests yourself. So this should be good. So we wanted to ask you about like your favorite piece of tech that you've invested in.
That I've invested in. Yeah, interesting. So the tech that I use a lot of tech kind of in my daily life. So I'll say that probably the one thing that changed my life the most, and it's going to be really boring, but it's Google Documents, Google Sheets, Gmail, Google Calendar. It's like that. Those tools have changed everything in the workplace. They've changed how everybody works. And they're so powerful. And I mean, you guys can remember to, like before around 2006 or so, 2007, when those things started to come out, right? Like it was a different world. So that, and there's so much you can do with it. But that, and then another one, which I think you guys might use, which has been really helpful for me, is Calendly.
Agreed.
And I'm a big proponent of people taking control of their calendar. And so my whole productivity system is built around controlling my calendar. And Calendly, it allows you to define when people can interrupt your calendar. And it's just a really powerful paradigm, right? So I think that like those two, and then if you're more technical than that, like Zapier. So if you use any kind of SaaS type tools or online tools, if you if you've done any kind of programming at all, even if you haven't, but maybe you do like Excel formulas or something, like you can use Zapier to really automate your life and tie together your calendar and your website and your blog and your payment system and whatever it is you can tie together with Zapier without having to write code.
That's awesome.
Yeah, really good.
Well, Kevin, this has been a fantastic conversation. We've kind of covered the gamut of angel investing, and I'm sure we could actually probably dive deeper. But where can people find you if they wanted to learn more about angel investing or pick your brain as an educator?
Sure, yeah. So I'm on Twitter. I'm pretty active on there. That's kind of my home base in the social media world. So I'm at K Taylor on Twitter. Also, people can connect to me on LinkedIn. If you just Google Kevin Taylor Stetson on LinkedIn, you'll find me. And also, I have a blog at founderscholar.com. where I blog on productivity, startups, motivation, things like that.
Awesome.
Excellent.
All right, Kevin. Well, thank you so much for your time today. It's been an awesome pleasure having you on the show. Thank you so much.
Hey, thanks. Yeah, thanks for having me. Thanks for the invite to do this, and good luck to all of you as you're investing in real estate. I'm sure that things are going to get really interesting over the coming months and years.
They are, for sure.
Yeah.
That's it for this episode of Tech Guys Who Invest. This is Adam.
And this is Kevin. Thank you so much for listening to us. Don't forget to join our Facebook page where we're building a community of investors so that we can share ideas, tips, and other ways to help us get out of the rat race. If you found value in this podcast, it would mean the world to us if you could share it with your network. Lastly, we love feedback. It's how we get better. So if you wouldn't mind spending 30 seconds and leaving us an honest review on iTunes or Stitcher or whatever platform you're using, that would be super sweet. If you want to get on Adam or Kevin's calendar, go to tgwipodcast.com/contact. We want to help you invest safely, wisely, and ultimately get you out of the rat race. Thanks again.